But switching gears, with the housing market as hot as it is now and with mortgage rates creeping still higher, we want to break down now how to plan your real estate investments in retirement. And for that, we're bringing in George Ratiu, Realtor.com manager of economic research, as part of our retirement segment brought to you by Fidelity Investments. George, thanks so much for joining us this afternoon. First off, this has been a seller's market for quite some time now. How long do you expect that that's going to last here in the U.S.?
That's the question of the hour, Emily. And indeed, when we look at most indicators, the market remains skewed in sellers' favors. After all, we started the year with about 5.8 million new single-family homes short. A decade of underbuilding brought us here. So that's been putting a lot of pressure on prices. However, as we've seen markets react to the geopolitical changes, to the Fed's tightening of monetary policy, we've seen mortgage rates surge basically toward 5%. And that's really putting a lid on demand. And I expect to see the markets return to more of a normal balance as a result of this as we move into summer. In addition, a Realtor.com survey we ran this year of homeowners across the country, it basically is showing that of those homeowners who plan to sell this year, about 64% are planning to do so in the next 6 months. And so that's really showing that we're expecting a ramp up in inventory to also bring more normalcy to these overheated markets we've seen over the past year.
Are there still regions or cities where you're seeing reasonable prices and relative value for someone looking to buy?
Absolutely. When you look across the country, in fact, we just released our list of most in-demand markets today, and many of those are in the Midwest and Northeast. When you think of markets like Columbus, Cleveland, these are markets that normally don't go through the boom and bust cycles in the same way as some of the Sunbelt markets. And so they continue to remain affordable for many people. And I know for those folks looking at retirement, some of these markets, whether they live there or whether they're looking to retire there, can be attractive.
So let's say you're someone who is retiring, perhaps wants to downsize in retirement or really in general. What are the tax implications that people should know about that? And how can people actually capture tax benefits from these kinds of moves?
Great question, Emily. And there, the important thing to remember for homeowners who are looking to sell their home and move to a smaller one, to a different home in a different state, perhaps, it's important to remember that, by tax rules, by IRS regulations, if you lived in the home for 2 of the last 5 years, it basically is your primary residence. So selling it allows you to shelter about $250,000 if you're single, or up to $500,000 in any capital gains. Those are pretty generous margins. But if someone has bought their home in the 1960s, perhaps think back to California or some of these other markets, they may have a significant gain. So it's important to talk to a tax advisor to understand your personal circumstances. But obviously, being able to sell a home in a high cost market and finding a market that's more affordable, as we're seeing a lot of people do, whether it's moving from California, New York, Boston, Chicago, to places like Arizona, Nashville, in Tennessee, Florida, or places in Nevada that A, have no state income tax, B, in many cases have a lot more affordable housing, allows people to not only take the home equity with them, but actually be able to save money into their golden years going forward through lower cost of both living and housing.
And in general, if you're already in retirement or you're about to be, is it too late, would you say, to invest in real estate as a source of retirement income and see a return or rental property cash flow from that?
For many folks, it really depends on their circumstances. And what do I mean by that? If you're already in an expensive market and you plan to downsize, for example, to somewhere that's less expensive, you're taking a lot of potentially cash with you. You can buy a home that's less expensive than what your primary home was. And if you have anything left over, obviously you could invest in something that would be rentable and produce cash flow. The trick here is markets today are at record high prices. So the important thing to remember for a lot of folks looking into retirement, the costs can really take a toll on a lot of cash flow. So do the math carefully. Look at prices, look at the rents in the area you're considering an investment, and consider the fact that mortgage rates are rising. When you put these numbers together, if your cash flow is not positive, I would say take a second look and maybe pause for a while.
A lot of important considerations to keep in mind. George Ratiu, Realtor.com, Manager of Economic Research. Thank you so much and have a great weekend.